Welcome to our financial statement analysis course. Financial statement analysis involves reviewing a company's financial statements, such as the income statement, balance sheet, and cash flow statement, to assess its financial performance and health. The process typically includes the following steps, which we will cover in this course. 1. Review the company's financial statements and related notes. 2. Calculate key financial ratios, such as liquidity ratios, profitability ratios, and debt ratios. 3. Compare the company's financial performance and position to industry averages and/or prior periods. 4. Identify any trends or significant changes in the financial statements. 5. Interpret the results of the analysis and draw conclusions about the company's financial performance and health. 6. Use this information to make informed investment or credit decisions. It's also important to have a good understanding of accounting principles and financial concepts. These will be covered in this course. First, we will start off with an income statement, also known as a profit and loss statement. It is a financial document that shows a company's revenues, costs, and expenses over a specific period of time, such as a quarter or a year. The income statement is used to calculate a company's net income, which is equal to revenues minus expenses. The net income is also known as the bottom line of the income statement. The income statement is typically divided into two sections, revenues and expenses. Revenues are the amounts earned by the company from its operations and are usually listed first on the income statement. Expenses are the costs incurred by the company in order to generate those revenues and are usually listed below the revenues. The difference between revenues and expenses is the net income, which can be either a profit or a loss. The income statement provides valuable information about a company's financial performance and can help investors, creditors, and managers evaluate the company's profitability and efficiency. It can be used in conjunction with other financial statements, such as the balance sheet and cash flow statement, to gain a comprehensive understanding of a company's financial position and performance. Next, the balance sheet is a financial statement that shows a company's assets, liabilities, and equity at a specific point in time, usually at the end of a quarter or a year. The balance sheet is called a balanced sheet because the assets of the company must balance with the liabilities and equity of the company. The balance sheet is divided into two sections, assets and liabilities plus equity. 1. Assets are the resources owned by the company, such as cash, investments, inventory, and property, that have monetary value and are expected to provide future economic benefits. 2. Liabilities are the obligations of the company, such as loans and accounts payable, that are expected to be settled by the company using assets or services. 3. Equity represents the residual interest in the assets of the company after liabilities are deducted, often referred to as the net assets or shareholders' equity. The balance sheet provides a snapshot of a company's financial position at a specific point in time, and gives an idea of how much of the company is financed by debt and how much by equity. It can be used in conjunction with other financial statements, such as the income statement and cash flow statement, to gain a comprehensive understanding of a company's financial position and performance. The third financial statement is the statement of cash flows, also known as the cash flow statement. It is a financial statement that shows the cash inflows and outflows of a company over a specific period of time, such as a quarter or a year. The statement of cash flows is used to track a company's cash balance over time and to understand how and where cash is being generated or used. The statement of cash flows is divided into three sections: cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. 1. Cash flows from operating activities reflect the cash generated or used by the company from its main revenue-generating activities, such as selling goods or services. 2. Cash flows from investing activities reflect the cash generated or used by the company from its investments in long-term assets, such as property, plant, and equipment, or in securities. 3. Cash flows from financing activities reflect the cash generated or used by the company from obtaining or repaying debt and from issuing or repurchasing equity. The statement of cash flows is important because it shows the cash available to a company to pay its bills, invest in new opportunities, and distribute to its shareholders. It can be used in conjunction with other financial statements, such as the income statement and balance sheet, to gain a comprehensive understanding of a company's financial position and performance. It is important that you familiarize yourself with financial statements. There is a relationship between the three, which always hold true, regardless of the company. Below are examples of an income statement, balance sheet and income statement. They are included in the course, if you would like to follow along. Below is an example of an income statement for a retail company called XYZ Inc. for the year ending December 31, 2022. Income statement. Revenues. 1. Sales $12 million. 2. Other income $500,000. 3. Total revenues $12,500,000. Expenses. 1. Cost of goods sold $8 million. 2. Sales and marketing expenses $1,500,000. 3. General and administrative expenses $1,200,000. 4. Depreciation and amortization $500,000. 5. Interest expense $200,000. 6. Total expenses $11,400,000. Net income $1,100,000. This income statement shows that XYZ Inc. generated $12,500,000 in revenues in the year ending December 31, 2022, from sales and other income. The company had expenses of $11,400,000 during the same period, including cost of goods sold, sales and marketing expenses, general and administrative expenses, depreciation and amortization, and interest expense. The company's net income for the year was $1,100,000. Please note that this is a simplified example, and in reality an income statement would include more detailed information and also follow the GAAP or IFRS depending on the company location. In addition, it is also important to have a good understanding of accounting principles and financial concepts to fully analyze the statement and make informed decisions. Below is an example of a balance sheet for a retail company called XYZ Inc. as of December 31, 2022. Balance sheet. Assets. 1. Cash and cash equivalents $2 million. 2. Accounts receivable $1,500,000. 3. Inventories $3 million. 4. Property, plant, and equipment $5 million. 5. Total assets $11,500,000. Liabilities and shareholders' equity. 1. Accounts payable $1,200,000. 2. Short-term debt $1 million. 3. Long-term debt $2 million. 4. Total liabilities $4,200,000. 5. Shareholders' equity. Common stock $1 million. Retained earnings $6,300,000. Total shareholders' equity $7,300,000. 6. Total liabilities and shareholders' equity $11,500,000. It is important to note that assets equals liabilities plus shareholders' equity. As you can see, $11,500 equals $11,500 This balance sheet shows that XYZ Inc. had assets of $11,500,000 as of December 31, 2022, including cash and cash equivalents, accounts receivable, inventories, and property, plant, and equipment. The company also had liabilities of $4,200,000 as of December 31, 2022, including accounts payable. Here is an example of a cash flow statement for a retail company called XYZ Inc. for the year ending December 31, 2022. Cash flow statement. Cash flows from operating activities. 1. Net income $1,100,000. 2. Adjustments for depreciation $500,000. Increase in accounts receivable $300,000. Increase in inventories $500,000. Increase in accounts payable $200,000. 3. Net cash provided by operating activities $1 million. Cash flows from investing activities. 1. Purchase of property, plant, and equipment $2 million. 2. Net cash used in investing activities $2 million. Cash flows from financing activities. 1. Proceeds from issuance of common stock $500,000. 2. Repayment of short-term debt $500,000. 3. Net cash provided by used in financing activities $0. Net decrease in cash and cash equivalents $1 million. Cash and cash equivalents at beginning of period $3 million. Cash and cash equivalents at end of period $2 million. This cash flow statement shows that XYZ Inc. generated $1 million in cash from operating activities during the year ending December 31, 2022. Mainly from its net income and adjusting for depreciation, changes in accounts receivable and inventories and accounts payable. The company used $2 million in cash for investing activities, mainly for purchase of property, plant and equipment. The company had no cash flows from financing activities, and it ended the year with $2 million in cash and cash equivalents, a decrease of $1 million compared to the beginning of the year. Please note that this is a simplified example, and in reality a cash flow statement would include more detailed information and also follow the GAAP or IFRS depending on the company location. In addition, it is also important to have a good understanding of accounting principles and financial concepts to fully analyze the statement and make informed decisions. Reviewing financial statements and related notes involves analyzing the information presented in these documents to assess a company's financial performance and health. The process typically includes the following steps. Read through the financial statements and related notes carefully. Pay attention to the key financial figures and ratios presented in the statements, such as revenues, expenses, net income, assets, liabilities, and equity. Understand the accounting principles and methods used by the company. This will help you to interpret the information presented in the financial statements and to make comparisons with other companies. Look for any significant changes or trends in the financial statements, such as changes in revenues, expenses, or net income. This can help you to identify any potential risks or opportunities for the company. Review the related notes, which provide additional information and explanations about the financial statements. These notes often include information about the company's accounting policies, significant transactions, and potential risks. Compare the company's financial performance and position to industry averages and/or prior periods. This will help you to evaluate the company's relative performance and to identify any significant changes over time. Look for any red flags or warning signs, such as large changes in key financial figures, or ratios, or large discrepancies between the financial statements and the related notes. Finally, use the information gathered from the financial statement analysis to make informed investment or credit decisions. It's important to keep in mind that financial statement analysis is an ongoing process that requires regular monitoring of a company's financial performance over time. It's also good to have a good understanding of accounting principles and financial concepts. It may be helpful to seek the help of an experienced financial analyst or accountant to guide you through the process. Calculating key financial ratios is an important step in financial statement analysis. Financial ratios are used to evaluate a company's performance and financial position by comparing different figures from its financial statements. Here are some examples of how to calculate some common ratios. 1. Liquidity ratios. 1. Current ratio equals current assets, current liabilities. 2. Quick ratio equals current assets, inventory, current liabilities. 1. Profitability ratios. 1. Gross profit margin equals gross profit, revenues. 2. Net profit margin equals net income, revenues. 3. Return on equity (ROE) equals net income, shareholders' equity. 1. Debt ratios. 1. Debt to equity ratio equals total liabilities, shareholders' equity. 2. Interest coverage ratio equals operating income, interest expense. It's important to keep in mind that financial ratios should be used in conjunction with other financial statement analysis techniques. They should be compared to industry averages or prior periods to gain a comprehensive understanding of a company's financial performance and position. It's also good to have a good understanding of accounting principles and financial concepts. It may be helpful to seek the help of an experienced financial analyst or accountant to guide you through the process. Identifying trends or changes in a company's financial statement is an important step in financial statement analysis. Here are some methods to identify trends or changes in a company's financial statement. Time series analysis. This involves comparing the company's financial statements over multiple periods, e.g., comparing the current year's income statement to the prior year's income statement. Try to identify any trends or changes in key financial figures, such as revenues, expenses, or net income. Cross-sectional analysis. This involves comparing the company's financial statements to those of other companies in the same industry to identify any significant differences or changes in key financial figures or ratios. Trend analysis. This involves plotting key financial figures or ratios over time, e.g., net income over the last 5 years, to identify any upward or downward trends. Ratio analysis. This involves comparing key financial ratios over time, e.g., current ratio over the last 5 years, to identify any changes in the company's liquidity or profitability. Common size analysis. This involves expressing all the financial statement items as a percentage of a common base figure, usually revenues, to allow for easy comparison between different periods and companies. DuPont analysis. This is a more advanced method that uses a series of financial ratios to analyze a company's return on equity. It's important to keep in mind that financial statement analysis is an ongoing process that requires regular monitoring of a company's financial performance over time. It's also good to have a good understanding of accounting principles and financial concepts. It may be helpful to seek the help of an experienced financial analyst or accountant to guide you through the process. Here is an example of financial statement analysis of a retail company, XYZ Inc. It has provided its financial statements for the current year, Year 1, and the previous year, Year 0, for analysis. The financial statements include the income statement, balance sheet, and statement of cash flows. Review the financial statements. The income statement shows that the company's revenues for Year 1 were $10 million, which is a 5% increase from Year 0. The company's expenses for Year 1 were $8 million, which is a 3% increase from Year 0. The company's net income for Year 1 was $2 million, which is a 2% increase from Year 0. The balance sheet shows that the company's assets for Year 1 were $12 million, which is a 6% increase from Year 0. The company's liabilities for Year 1 were $5 million, which is a 4% increase from Year 0. The company's equity for Year 1 was $7 million, which is a 10% increase from Year 0. The statement of cash flows shows that the company generated $2 million in cash from operating activities, $1 million in cash from investing activities, and $1 million in cash from financing activities. Calculate key financial ratios. The company's current ratio is 2:1, which indicates that the company has sufficient liquidity to meet its short-term obligations. The company's gross profit margin is 20%, which indicates that the company is generating a healthy profit margin. The company's debt-to-equity ratio is 0.71:1, which indicates that the company has a low level of debt and a strong equity position. Compare the company's financial performance and position to industry averages. The company's current ratio is higher than the industry average of 1.5:1. The company's gross profit margin is lower than the industry average of 25%. The company's debt-to-equity ratio is lower than the industry average of 1:1. Identify any trends or significant changes in the financial statements. The company's revenues and expenses have been increasing over time, indicating steady growth. The company's assets and equity have been increasing over time, indicating a strong financial position. The company's liabilities have been increasing at a slower rate than assets and equity, indicating a strong equity position. Interpret the results of the analysis and draw conclusions. Based on the analysis, it appears that XYZ Inc. is a financially healthy company with steady growth and a strong financial position. The company's liquidity is good, and its profitability is in line with the industry average. The company has a low level of debt and a strong equity position. However, the company should focus on increasing its gross profit margin to be in line with the industry average. It's important to note that this is a simplified example, and in reality a more detailed analysis would be required and multiple methods of analysis would be used to gain a comprehensive understanding of the company's financial position and performance. Financial statement analysis is used to make informed investment or credit decisions. Here are a few examples of typical investment or credit decisions that are made off of financial statement analysis. Investment decisions. Investors use financial statement analysis to evaluate a company's financial performance and health before making investment decisions. If a company's financial statements indicate that it is performing well, with steady growth, high profitability, and a strong financial position, an investor may choose to invest in the company's stock or bonds. On the other hand, if a company's financial statements indicate that it is performing poorly, with declining revenues, high expenses, and a weak financial position, an investor may choose to avoid investing in the company. Credit decisions. Lenders use financial statement analysis to evaluate a company's creditworthiness before making credit decisions. If a company's financial statements indicate that it is financially healthy, with high liquidity, low debt, and high profitability, a lender may be more likely to approve a loan to the company. On the other hand, if a company's financial statements indicate that it is financially weak, with low liquidity, high debt, and low profitability, a lender may be less likely to approve a loan to the company. M&A decisions. Financial statement analysis can be used by companies to evaluate potential acquisition targets and to assess the financial impact of a merger or acquisition on their own company. This information can be used to make strategic decisions about whether to pursue or reject potential merger or acquisition opportunities. Budgeting and forecasting. Financial statement analysis can be used by companies to create budget and financial forecast. This can help the company to identify areas of improvement or opportunities for growth. Performance evaluation. Financial statement analysis can be used by companies to evaluate the performance of their different business units and make strategic decisions about how to allocate resources and improve performance. It's important to keep in mind that financial statement analysis is only one aspect of making investment or credit decisions and should be used in conjunction with other forms of analysis, such as industry analysis, market analysis, and management analysis. Valuing a company is the process of determining the intrinsic or true worth of a business. There are several methods to value a company. Here are a few common ones. Earnings-based valuation methods. These methods use financial information, such as earnings or cash flow, to estimate the value of a company. Common earnings-based methods include the price-to-earnings (P/E) ratio, price-to-cash flow (P/CF) ratio, and the price-to-earnings-to-growth (PEG) ratio. Asset-based valuation methods. These methods use a company's balance sheet information to estimate the value of a company. Common asset-based methods include the price-to-book (P/B) ratio and the liquidation value method. Market-based valuation methods. These methods use information about a company's market, such as stock price, to estimate the value of a company. Common market-based methods include the market capitalization and the enterprise value methods. Discounted cash flow (DCF) method. This method calculates the present value of a company's future cash flows and is a widely used method to value a company. It requires estimates of future cash flows, a discount rate and a terminal value. Comparable companies analysis. This method uses the financial information of similar companies that are publicly traded to estimate the value of a company. It involves identifying comparable companies and comparing their financial ratios and multiples such as P/E, P/S and EV/EBITDA. It's important to note that each method has its own assumptions, strengths, and weaknesses, and there's no single correct way to value a company. It's advisable to use multiple methods and consider various factors such as industry trends, economic conditions, and management quality to arrive at a more accurate estimate of a company's value. Additionally, it is also important to have a good understanding of accounting principles and financial concepts to fully analyze the statement and make informed decisions. Finally, it may be helpful to seek the help of an experienced financial analyst or valuation expert to guide you through the process. Earnings-based methods use financial information, such as earnings or cash flow, to estimate the value of a company. Here are a few common earnings-based methods to value a company. Price-to-earnings (P/E) ratio. This method calculates the value of a company based on its current stock price and earnings per share (EPS). The P/E ratio is calculated by dividing the current market price of a company's stock by its EPS. The higher the P/E ratio, the more expensive the stock is considered to be. Price-to-cash flow (P/CF) ratio. This method calculates the value of a company based on its current stock price and its cash flow per share. The P/CF ratio is calculated by dividing the current market price of a company's stock by its cash flow per share. The higher the P/CF ratio, the more expensive the stock is considered to be. Price-to-earnings to growth (PEG) ratio. This method takes into account the company's growth rate in addition to its P/E ratio. The PEG ratio is calculated by dividing the P/E ratio by the company's projected earnings growth rate. A PEG ratio of 1 is considered to be fairly valued, while a ratio above 1 suggests that the stock is overvalued, and a ratio below 1 suggests that the stock is undervalued. Price-to-sales ratio (PS). This method calculates the value of a company based on its current stock price and its revenue per share. The P/S ratio is calculated by dividing the current market price of a company's stock by its revenue per share. The higher the P/S ratio, the more expensive the stock is considered to be. It's important to note that these methods are based on historical financial data and don't take into account future growth or potential changes in the company's financial performance. Asset-based valuation methods involve determining the value of a company based on the value of its assets. Some common asset-based valuation methods include book value. This method calculates the value of a company by subtracting its liabilities from its assets. Liquidation value. This method calculates the value of a company's assets if they were to be sold off. Replacement cost. This method calculates the cost of replacing a company's assets. Net asset value. This method calculates the value of a company's assets minus its liabilities, and is commonly used in the valuation of investment funds. Capitalization of earnings. This method involves calculating the value of a company by multiplying its earnings by a capitalization rate. As you'll see, there is overlap with the earnings-based methods, but it doesn't hurt to go over them again. Price to book value. This method calculates the value of a company by dividing its market capitalization by its book value. It's important to note that these methods should be used in combination with other methods to get a comprehensive valuation of the company. Market-based valuation methods involve determining the value of a company based on its market performance and market conditions. As you'll see, there is overlap with the earnings-based methods, but it doesn't hurt to go over them again. Some common market-based valuation methods include market capitalization. This method calculates the value of a company by multiplying its stock price by the number of outstanding shares. Price to earnings (P/E) ratio. This method calculates the value of a company by dividing its stock price by its earnings per share. Price to sales (P/S) ratio. This method calculates the value of a company by dividing its stock price by its revenue per share. Price to cash flow (P/CF) ratio. This method calculates the value of a company by dividing its stock price by its cash flow per share. Dividend discount model (DDM). This method calculates the value of a company based on the present value of its expected future dividends. Earnings multiplier. This method calculates the value of a company by multiplying its earnings by a specific number, which is derived from the industry average. Comparable company analysis. This method involves comparing a company's financial metrics and market performance to those of similar companies in the same industry. Precedent transactions. This method involves looking at the prices at which similar companies have been sold in the past to estimate the value of a company. It's important to note that these methods should be used in combination with other methods to get a comprehensive valuation of the company. The discounted cash flow method was one that I always used as an equity analyst, so here it is more in depth. The discounted cash flow (DCF) method is a method of valuing a company by estimating its future cash flows and discounting them to their present value. The DCF method involves the following steps. Projecting future cash flows. The first step in a DCF analysis is to project future cash flows for the company. This typically involves creating a detailed financial model that estimates the company's revenues, expenses, and other cash flows for a period of several years into the future. Selecting a discount rate. The next step is to select an appropriate discount rate, which is the rate at which the future cash flows will be discounted to their present value. The discount rate should reflect the company's risk and the opportunity cost of investing in the company. Discounting the cash flows. Once the future cash flows have been projected and the discount rate has been selected, the next step is to discount the cash flows to their present value. This is typically done using the formula, present value equals future cash flow, 1 plus discount rate, (n), where n is the number of years into the future the cash flow is projected. Summing the present values. The final step is to sum the present values of all the projected cash flows to arrive at an estimate of the company's intrinsic value. Compare the intrinsic value with the current market price to make a decision on buying, holding or selling the stock. It's important to note that the DCF method is highly sensitive to the assumptions made and the accuracy of the future cash flow projections. Therefore, it's important to use conservative and realistic assumptions when performing a DCF analysis.